In this video, traders, we'll look at the very basics of the bid, ask prices and the spread. Great for new traders, this video. Stay tuned. Hey traders, a warm welcome to you. If you are new to the channel, consider subscribing for more videos from me and others on the channel, educate you on trading, setup, strategy, etc. But in this video, we're going to look at bid and ask prices. So if you're brand new and you're wondering what is going on, what's the bid, what's the ask, what's the spread, this video should explain it to you. Okay, so let's imagine we have a stock, and very often we see a stock price quoted at, let's say, for example, $21.10, okay? And that's when we're looking at charts, we're looking at the closing price, we only see one specific price. Now, when we actually want to make a transaction, the price that we buy at and the price that we sell at is going to be different. So if we are looking at this stock, and let's say we look at this stock now, and it's at 21.08, these are the prices that we often see, and we see these two things, 21.12, for example. This is what's known as the bid and the ask. This side is the bid and this side is the ask. And basically what that means is that if you want to buy this stock, you have to buy at the ask. There are ways that are more advanced techniques that we can do to not do that, which I might cover in the end of this video. But just for now, if we keep it simple, we want to buy that stock, we want to buy it immediately, we will be paying $21.12. If we want to sell that stock, if we own the stock, we will be selling it at 21.08. So that's the bid, that's the ask, sometimes known as the offer in the UK. Now, all very well and good, and we see that quoted, and we understand if we buy, that's the price we're buying, if we sell, it's the price we're selling at. But the question remains, okay, how are these set? How are these determined? Who determines the price of this bid and who determines the price of the ask? Final thing is, guys, before I go into that, the difference between the two is what's called the spread. So the spread in this instance would be 4 cents, right? 12 minus 8. So that's basically what's called the spread. So we've got the bid price, the ask price, and the spread is what the difference in between. So who creates the bid price, who creates the ask price? Unlike other consumer products, if you like milk or bread, whatever it may be, we set the price. The buyers and the sellers actually set the price for this. So let me explain an example. So if you're looking to buy this stock, and let's just call this one ABC stock, right? You're looking to buy this stock, you have to pay $21.12. Now, if you are a bigger institution or you are a more advanced trader, you have the option to request a stock price by using a limit order, and a limit order will allow you to change this price, because what you could do, you could have a resting limit order in at $21, which basically says, you know what, I want to buy this thing at $21. But if you wanted to be a little bit more aggressive, you could put a limit in for $21 and let's say 10 cents. Now, if you have a direct access platform, this wouldn't always apply for some of the deep discount brokerage. Your limit order wouldn't affect the price. It would just sit there and be executed if the trade went through. But if you had direct access, which more advanced investors and traders do, obviously institutions do, that then will change the bid price, because the bid price is the highest price that someone is willing to pay for that stock at that moment in time. In this example here, it's 21.08. If you came in, or an institutional investor came in and said, I'm prepared to buy stock for 21.10, the bid price would then change from 21.08 to 21.10, and that would change the bid price for everybody. So if anyone wanted to come in and sell stock, that's the price that they would get for selling that stock, and vice versa as well. If you had stock you wanted to sell, you could come in and offer lower than that, and the lowest price offered for that stock is what becomes the new ask. So it really is supply and demand, and based on what the consumer or the end user or whoever actually has the stock is willing to buy or sell at. Now, we have scenarios also where, I mean, this is great. You can see this is great. If there's a lot of volume, a lot of thickness, a lot of volume flow and trades going through and transactions, you can see this keeps this narrow, which is why we have very narrow spreads when we look really the cost of the spread relevant to, or relative should I say, to the cost of the stock. Very, very narrow. Now, if we have stocks that are less liquid, there's not enough volume going through, we have what's called market makers, and this I'm often short MMs for short. And market makers ultimately are paid to keep this spread reasonably tight. They're paid, or they're compensated, they're not paid as such, they're kind of compensated by being allowed to be market makers to basically create a spread. So you might find something like that. You might find a kind of 25-cent spread, or maybe a little bit less, but they will keep the spread narrow. They're constantly involved in this to make sure that the spreads don't go completely wide, because if they go completely too wide, it just basically reduces the ability for people to transact. If you've got a 50% spread, then it's absolutely worthless, and then the exchanges aren't going to make any money, no one's going to make any money. So these market makers are incentivized to do this. But without the market makers, we have basically the public. We basically have you and I, if we're advanced traders, we have or brokers acting on our behalf. Perhaps if we put in, we don't have direct access, we might say, hey, we want to buy stock at 21.10, and if we're a big enough client, they're going to put their order in for us. We're going to have institutions. All these multiple people combining create this bid spread and the ask spread. The important thing to note, guys, the bid price and the ask price, should I say, the spread is the difference between the two. The important thing to remember is when you're buying, we're buying on the ask. When we're selling on the bid. Yes, we have some advanced ways of doing it, but if you keep that in your mind, if you're a beginner trader, that's really easy and clear for you to understand. One thing to watch out if you're buying your first stock, you're making your first trade, is just to make sure that that spread isn't too wide. So you're buying a little more liquid stock, you're buying more liquid asset, and this applies obviously for stocks, it applies for futures contracts as well, for trading gold, trading crude oil, whatever, same kind of thing. But just watch out that spread's not too wide, and just see the thickness that you've got and availability in terms of volume. But bid spread, bid price, ask price, spread is a difference in between. All right, guys, good trading. If you're a new trader, welcome on board. Otherwise, if you're a seasoned veteran, you probably watched this video and you know all about it already, but you're still very welcome to watch anyway. All right, guys, see you in the next one. Take care. Keep your risk managed, whatever you do. Bye-bye.